Hello, everyone. Welcome back to another installment of the Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an equity strategist here at Zacks Investment Research, and this is an important update on the summary of earnings for the S&P overall and dissected by sector and industry group. So let's take a look at exactly how earnings have gone thus far in Q2 and the outlook for the remainder of 2025. Let's get started. So there's been a number of very, very impressive results that we've seen from the S&P 500 companies that have reported thus far. We are now, pretty much complete with Q2, with the vast majority of companies in the S&P 500 having now reported earnings for Q2, and earnings look spectacular. This is now the third quarter in a row where earnings growth has come in at a double-digit clip on a year-over-year basis. But especially for Q2, we have surpassed analyst estimates big time. The one difference between this quarter and the prior two quarters where we've seen very strong growth is that that growth was basically in line with estimates. I mean, it was still really good, impressive results, but the rate at which we have beaten estimates this quarter is tracking at the highest level in several years now. This has been very, very impressive. We'll take a look at some of the actual data. But the rate of beating estimates, both on the top line and the bottom line, has been notably higher this quarter in Q2 than in past quarters, significantly above the 5-year average. So earnings have been very strong. And what's also more impressive to me is not just the aggregate growth, not just the beat rate, but that the growth is coming from a variety of sectors. Um, Remember, a big reason why I've been bearish on the S&P during 2023 and the majority of 2024 is that the entirety of earnings growth for the S&P 500 came from just seven companies, right? The Mag 7. But now, even if you adjust out the earnings impact of the Mag 7, we are seeing positive and accelerating earnings growth. And it's coming from a variety of sectors, including very important, analytically important industries like retail, banks, industrials, and discretionary. We're getting, some good bullish commentary. We'll take a look at some quotes from key figures of mega cap technology and bank CEOs, as well as retail CEOs. So all of this together has really been the main factor why the markets have been so strong and so resilient despite tariff headwinds and other geopolitical tensions. This has now overall been the reason why analysts have revised estimates upward for the full year 2025 and for 2026. So this sets the tone for the rest of 2025, at least. Now, the main risk factor is that inflationary pressures do persist. Businesses are reporting rising costs as per the producer price index. This remains one of the reasons why there is some caution out there, maybe that the Fed may not cut rates as quickly as, others might hope, specifically President Trump would hope. But overall, the earnings picture has been very, very solid. So here is the aggregate number. Here we can see this is the overall S&P 500 earnings growth. Like I mentioned, this is now the third quarter in a row in which we have seen double-digit earnings growth on a year-over-year basis. But what's also very impressive is, remember, earnings can be manipulated, right? We can see above average earnings growth if companies buy back shares. We can see above average earnings growth if, companies simply lay off employees without seeing anything, all else held equal. We can see above average earnings growth through different, channels that control costs. But what's much harder to manipulate is revenue growth because that is a reflection of raw demand for their products and services. And here you see 6% top line growth. This is very impressive. This is tracking at the highest levels in several years since we exited the pandemic. Um, so this is again very, very impressive top line growth that we're seeing here. Now you can see on this chart that the growth is expected to taper For Q3, the growth rate is much more modest, as well as for Q4. But this has been largely communicated and, already baked into the expectations of analysts. This has been well communicated by management. So even if growth does drop, to 4.8% next quarter and 6% the following quarter, this is largely in line with, the estimate. So remember, these are the estimated numbers here. So if growth does fall, remember, this has been largely expected, primarily because the comps are starting to get difficult. We're now looking at Q3 2024 comps. And remember, Q3 2024 was still quite impressive growth. So the comps are starting to get difficult. But as you can see, we're still bullish, heading into 2026. And this has been, communicated at this point quite well, by management since we now have, half of 2025 fully baked in. Here you can see a decomposition of earnings growth for Q2, by sector. And some of the sectors that I look at very closely are consumer discretionary, retail, materials, industrials, and financials, and transportation, because these industries together are your key cyclical industries. Together, they really show the true state of the business cycle, of the aggregate US business cycle. Where are we in the business cycle? Because these are largely mature companies, largely cyclical companies. These are the areas where earnings start to recover the earliest, and during, recovery phases, exiting recessions. And these are also the industries that get hit the first when we are entering recession. And if we look at it over here, consumer discretionary on a top line basis up 3.3%. That's an acceleration from Q1 of 1.2%. Retail revenue growth up 5.6%. Materials revenue growth up 4.7%. Industrials up 2.8%. Financials up 3.9%. And transportation is the only sector among the key cyclical industries that I look at that is actually down. So that's the one negative spot here. But besides them, the other five industries are very robust. So on the aggregate, even cyclical sectors that are very, very important to look at from an analytical standpoint are in a state of expansion, and several of them are accelerating to the upside. Most of them are. So again, this has been very bullish, and here you can see that on the aggregate, the S&P revenue growth has been 6% year over year. Very, very impressive. Now, one of the reasons why I was bearish in 2023 and much of 2024 was because of this chart right here. Look at the difference that we have seen. The blue line represents the aggregate S&P 500 earnings growth, and we were actually in contraction, in through mid 2023. Now, this is primarily because the comps were very high exiting the pandemic. As we exited the pandemic, we saw earnings growth, up in the 50% ballpark. So as we were normalizing that, cycle peak there, we did fall into contraction very briefly, but we can see that, the S&P overall exited contraction and went back to expansion as of Q4 of 2023. But I remained bearish at that time because if you look at it, just removing the impact of the Mag 7, which is in the orange line here, earnings were still negative and remained so even through Q1 of 2024, and it just barely peaked above water here in Q2 of 2024. But since then, look at what's happened even to earnings growth for the S&P 500, excluding Mag 7, again, this orange line here. And we are seeing not only positive growth, but accelerating growth on a year-over-year basis. And now through Q2, the S&P 500 earnings growth, excluding Mag 7, is at 7.2%. Again, that's very, very impressive, because, again, we were negative excluding the impact of the Mag 7. Remember, the reason why this is important is because the Mag 7 represents an outsized proportion of the S&P 500. Right now, we are in unprecedented territory where the seven biggest companies dominate something like 30% of the index. That's an all-time high. We've never had concentration risk this big in the index in history. And so why is this important? It's important because there is a skew effect in play right now on the aggregate numbers because seven companies are reporting exceptional earnings growth because of the frenetic pace of investments in AI. But that reflective of the aggregate economy? Maybe not. Maybe so, maybe not. And that's why if we remove the impact of those seven companies, here is what it looks like. And this trend is very clearly bullish. And so 7.2% earnings growth for, the rest of the 493 companies, I would say is a good overall stable number. And the direction in which earnings growth is moving towards is also very, very promising. So this chart is very important to see from an analytical standpoint. Excuse me. And that's why we like to see that there. Pardon me. So this is what the numbers look like. S&P 500 excluding Mag 7. In 2023, we were down 4.9%. That number improved to 4% last year, and we're now at 6.5% expected for 2025. Again, very, very positive trend to notice there. And the tone of managements is mostly bullish. You can see some of the quotes, the key quotes I've just assembled here. Sundar Pichai, CEO of Alphabet, says that we had a standout quarter with robust growth across the company. We are leading at the frontier of AI and shipping at an incredible pace. AI is positively impacting every part of the business, driving strong momentum. With this strong and growing demand for our cloud products and services, we are increasing our investment in capital expenditures in 2025 to approximately 85 billion and are excited by the opportunity ahead. So remember, CapEx is a key, indicator as to future earnings growth for companies, and CapEx, especially among Mag 7, remains very, very strong. A lot of analysts thought that it would start to taper now because we are now in year 2 or year 3 of this AI CapEx boom. And many people, including myself, thought that the pace of spending on data centers, on chips, for training and inference would have slowed by now, but it really hasn't. It has not slowed just yet. So this really reflects the bullishness that companies have with regards to the potential of these investments, with regards to what it might mean for earnings growth in the future. So remember, capital expenditures are a leading indicator to future earnings. Satya Nadella, CEO of Microsoft, we're innovating across our tech stack to unlock the full ROI of AI to capture the massive opportunity ahead. Already, our AI business has surpassed an annual revenue run rate of 13 billion, up 175% year over year. Outside of technology, let's take a look. The CEO of Home Depot, Ted Decker, our second quarter results were in line with our expectations. The momentum that began in the back half of last year continued throughout the first half as customers engaged more broadly in smaller home improvement projects. This is important as a bellwether of the construction industry. Jamie Dimon, CEO of JP Morgan, another strong quarter, generating net income of 15 billion or net income of 14.2 billion, excluding a significant item. Each of the lines of businesses performed well. The U.S. economy remained resilient in the quarter. The finalization of tax reform and potential deregulation are positives for the economic outlook. However, significant risks persist including from tariffs and trade uncertainty, worsening geopolitical conditions, high fiscal deficits, and elevated asset prices. So again, a little bit of a tone of cautious optimism, but Jamie Dimon looking quite bullish for JP Morgan. Doug McMillon, CEO of Walmart, top line momentum we have in our business comes from how we're innovating and executing, connecting with our customers and members through digital experiences is helping drive our business. And the way we're deploying AI will make these experiences even better. Again, overall strong sort of color commentary from managements with regards to how their companies are doing. Mostly bullish with a little bit of cautious optimism sprinkled in there. Um, so, we are, again, overall very good on aggregate retail spending. We know this because in terms of real retail sales, this is, official numbers reported by the government. We have continued to see strong real retail sales, and that's being translated into actual retail revenue reported by companies, and therefore actual retail earnings, reported by companies. But of course, tariffs remain a major headwind for companies. But thus far, revenue and earnings have remained quite strong, and retail spending overall has remained quite strong, and the trend of that direction has been positive, and evolving up. So because of the strong overall results for Q2 and bullish commentary, this is pushing up Q3 expectations. We're at 4.8% right now, which is still a significant deceleration from what we saw in Q2, but this has been largely communicated. It's well expected, well in advance. And just a couple of weeks ago, we were at 4.1% expected earnings growth in Q3, and that's been ratcheted up to 4.8%. So again, the trend of that number is up as well. That's good to see. And specifically for technology, we've seen a big jump. Remember, like I mentioned, analysts expected that the pace of AI spending, the pace of investments would slow by now, but it doesn't look like that's the case. And so, estimates are now being revised back up, from 6.3% just in early July to now 10.8%. So again, we continue to see tailwinds from technology, which is very bullish overall. So again, like I said, Q3 and Q4 should see significantly lower year-over-year growth rates than what we saw in the first half, mainly because the comps are starting to get hard. But overall growth expectations for fiscal year 2026 remain robust and remain in double-digit range. So some of the takeaways here, earnings are very bullish, but remember, the S&P trades at a very highly elevated 23 times forward earnings estimates. So 23 times forward-looking earnings estimates. And remember, forward-looking estimates are already bullish to begin with. There are already bullish growth expectations for the next year. And so the market is trading at a high multiple on very high expectations. So the bar, in my view, is very high. If you look at it, the equity risk premium, right, which is the forward earnings yield minus the 10-year yield, this is in the top decile out of all equity risk premiums observed over the past 40 years. This means that we are in the richest decile, the richest 10% of the time of the last 40 years, which really means that, bullish expectations are priced in, are largely priced in. Historically speaking, market returns over the next 5 years have been poor at these levels. So I don't expect a lot of return coming from multiple expansion the way we saw in 2023 and 2024. A huge portion of the returns that we saw those years, remember, we generated 25% returns in each of those last 2 years. But the vast majority of those returns came from multiple expansion. And so I believe going forward, even though earnings have been strong, We should not see significant returns like we saw in 2023 and 2024 because of the fact that we're already starting from very highly elevated multiples. So what I'm trying to say is I think that the returns that we see in the market going forward are largely going to track in line with actual earnings growth. So earnings growth is going to be where returns come from, and that's pretty much why we've seen this year that despite the fact that we've had strong earnings growth this year, market returns have been pretty much in line with those earnings growth. The S&P is up roughly 10% this year, and that's about as much as what the earnings are up this year. So I believe that the reason for this happening is because we're already at a very rich equity risk premium or very rich multiple relative to interest rates. So again, like I said, the returns to the market are going to largely track in line with whatever earnings growth the market can produce, which is exactly how things should be. That is a normal functioning market. Um, and so market momentum remains very exceptional again because earnings are exceptional right now. We just set a fresh all-time high this July. So, overall, what's the trade? I think the trade is to remain long the S&P 500 as long as it remains above the 10-week average true range. This is a technical indicator that I've been watching and tracking. It's had a pretty good track record of timing tops and bottoms, or sorry, not tops and bottoms, but timing um, and riding the big waves up and the big waves down. And so because we're at a rich multiple, right, we want to be very careful. We don't want to get complacent. Since we're trading at a top 10 decile in terms of valuation, I think it's very important to manage risk. And one way you can manage risk is by selling when the market breaks down from its 10-week average true range, and by going back long again when it recaptures the 10-week average true range. And you can check back on my videos, and if you wanted to track this average true range, I write a weekly column called the Weekly Market Analysis Report. You can access this report on Zacks.com or through your Zacks Advisor Tools subscription or your Zacks Research System subscription. You can access either of those two reports from those services there. And I write a weekly column that provides updates to what that level is. As of right now, that level is 59.01 for the S&P 500. So that means that if we have a weekly close, meaning a Friday closing below 59.01, I would exit the S&P 500 and go defensive. But as long as we trade above that level, and this number will change every week, but as long as we remain above the 10-week average true range, it makes sense to be long the market. So we're currently above that, comfortably speaking. So as long as that remains true, we ride the market's bullish momentum, but exit, and this provides us a very good risk management approach. But in my view, because we're at such a premium valuation, I think the best gains over the next 5 years are going to come from high quality companies with strong balance sheets, high ROIC, and attractive valuations. I manage a portfolio called the Zacks Deep Values Proxy. I would refer to that proxy, that portfolio, for a collection for some of my best ideas that satisfy these criteria here. High quality, strong balance sheets, high returns on invested capital, and very attractive valuations. Here are some of the top ideas I have from this, from this index, from this portfolio, little fuse. These are all mostly, some of them are small cap companies, some of them are mega caps like Johnson and Johnson, but overall, they represent, very, very attractive valuations for very high quality companies. So these are some of the companies, but if you want a full list of them, definitely refer to the Zacks Deep Value Proxy. You can access that through your Zacks Advisor Tools subscription or your Zacks Research System software subscription. And if you want more information on that, please do reach out to us. If you have any comments or questions with regards to anything I presented here, please do reach out to us. I'd love to hear from you. please give us a call at 1-866-794-6065 or send us an email to strategycall@zackspro.com with any of those questions. And I hope to see you all very soon and talk to you soon. Bye bye.